Welcome back. Let's talk about the taxation. Budget is 7 trading days ahead, and there is a lot of chatter and fear about what if there is some tweaks on the capital gains taxation front. Maybe increase the holding period from the current 1 year, or is there a possibility that the tax rate of 10% goes up? And I think there is fear, right, that if it comes through, there will be panic on the markets. Yeah. You've spoken to a lot of experts. Tell us.
When you said budget is 7 days away, it really made up sit up and take notice. I thought 23rd is still a while away.
Next week there is a holiday.
I don't know that. That's the good news.
That's
okay, we're digressing.
News, right? Listen, take that.
But coming back to the point, Rima, I think what you said is right. I think tax is really taking center stage in this budget because the last time was an interim one. It was just a vote on account. And there are sort of long-standing issues. One of them is, of course, one discussion point is going to be whether the government will put more money in the hands of people now that it has a fiscal headroom, and everyone's looking at the personal income tax regime, whether there will be any sweeteners there. But the second bigger perhaps issue from a market perspective is capital gains tax. Will we finally see some rationalization? And by rationalization, I don't necessarily mean a cut. More a simplification and a standardization of the capital gains regime. And that is what I think the ask has been from the industry perspective, from the individual perspective, from tax experts' perspective, given the regime, which has, of course, multiple rates, multiple asset classes, different holding periods, 1 year, 2 year, 3 years, STT paid, not paid, and whether you get the indexation benefit or not. So can this budget give us the first step towards at least a simplification of what has traditionally been a slightly complicated regime? Well, we have a full house of tax experts joining in to decode this. So let me, of course, welcome our experts in. We have Mr. Dinesh Kanabar, CEO of Dhruva Advisors. We have Kalpesh Maroo joining in from KPMG India, and Pranav Sayta from EY India. Gentlemen, good morning. Great to have you on. It's the usual discussion that we have in the run-up to a budget year after year. But I think the hopes are running a little higher this time around, given that the elections are behind us. Mr. Kanabar, let me throw the floor open to you. Let's deal with capital gains, and then we'll deal with the rest of the tax expectations. But on capital gains, what should we, brace ourselves for?
Thank you for having me. And let me begin to say that you mentioned about rationalization, and indeed the entire capital gains tax regime tends to be very, very cumbersome. We have short-term, long-term, listed, unlisted security, residential houses, holding period, resident, non-resident, and we all know that. Sometimes I wonder as to whether when you are asking for rationalization, are you be careful about what you wish for? So, for example, many years ago, we were all talking about dividend distribution tax being paid by the company and being substituted by a dividend tax. And when that happened, people started to complain to say that high net worth individuals are now paying far more than what they were paying. So when you start about talking rationalization, the questions which you put up, which are the usual questions, will we see a 1 year go up? Will we see the rates go up? And I'm no expert. I don't understand markets. I understand taxes. Is there a need for rationalization? Yes. Is there a more important need for a stability? I would say yes. I think both as a part of FICCI and the conversations that I have had with the government, I mean to say that the need to communicate to the world is that India has a stable tax regime, and that is not going to be tinkered year on year on year. On your earlier point as to whether the threshold limits for exemption should go up, probably yes, because there is an inflation and maybe there needs to be an automatic application of an index to take care of the inflation. But insofar as a capital gains tax is concerned, if you go back and talk about rationalization and making it simple, maybe there is a need, but I would say that there is even a greater need to communicate stability, which I think is very important. What has happened is that we have seen huge number of IPOs in the last 1 year. And I think that's very welcome for the industry. It shows foreign investments coming in, it shows domestic investments coming in. And the last thing that the government should do or would want to do is to really rock that boat, which is settled down and is going very, very well. So from my part, rationalization, very welcome. Is this the year? Maybe not.
Mr. Kanabar, I think you're being, careful, and perhaps for good reason. You're not putting numbers out there and specifics, but we're going to come down and, drill you further on that. Let me bring in the others as well. Mr. Sayta, if I could come to you, capital gains rationalization. We all talk about it. We all say we want it. The question is, what could be the right model? The specifics. So let's talk listed. Now, listed equity, the rate is 10% for long term, but the definitions are different. It's only 1 year. If it's unlisted, then it's 2 years. If it's property, then the definition is 2 years, and the rates also vary. So, if at all, you were to recommend to the government a formula to start simplifying and rationalizing this, where would one begin? What are the rates that you would move around?
Okay, thanks so much. So a very quick summary. There are so many different provisions right now that if even a person like me were to be asked a question on capital gains, I would have to go back, refer to the book before being sure what kind of rates, period of holding, and so on would apply. So it does call for some rationalization for sure. At the same time, without compromising, very correctly, as has been pointed out, the stability, predictability, which has been the hallmark of this government, not trying to do minimal tinkering of the laws all the time. That's been the hallmark, and that should continue. But I would feel 2-3 things can be done very simply. One could bracket assets maybe into 3 categories. One is risk-bearing financial assets. The other is other financial assets. And a third is all the other assets whatsoever. Just have these 3 baskets. When I say risk-bearing financial assets, I would normally put within it shares, equity-oriented mutual funds, and maybe REITs, InvIT units. So those are the 3 types of risk-bearing financial assets. All other financial assets I would put separately. And the third bucket would be other than financial assets, which would mostly be in the nature of gold, silver, jewelry, immobile properties, and so on and so forth, the entire rest of the bucket. I would feel the tax rates can be rationalized as, for the long term, 10% on the risk-bearing financial assets, 20% inclusive of the benefit of indexation for the other financial assets, and as well as 20% for the other third bucket. So the second and third bucket might be similar rates of taxation with indexation benefits. And so far as the period of holding is concerned, it could be rationalized as 12 months, or meaning 1 year, for the financial assets in total, whether it is risk-bearing or otherwise. And for all other assets, it could be, for example, 36 months. That, I think, would keep it very simple. The short-term capital gains tax rates could be 15% for the risk-bearing financial assets, and maybe the normal slab rates or whatever the regular rates of income tax might be for all the other categories of assets. That, I think, would be very simple, but at the same time address the need of stability, predictability, and fairness and transparency for all.
Pranav, so just for the sake of clarity, and I think you really simplified it. You're saying just bucket it into 3 separate categories of asset classes: risk-bearing financial assets, other financial assets which are non-risk-bearing, all other types of financial assets, and other assets which are non-financial assets, which is where your gold and perhaps a movable property can come in. You're saying 10% for risk-bearing and 20% each for the others. And in terms of the duration, how much did you say should risk-bearing be? Or should it be continued? Should it continue to be the present regime of 12?
All financial assets 12 months. Okay. Other than financial assets, gold, silver, jewelry, immobile property, 36 months.
36 months. So all financial assets defined short term as less than 1 year, long term as above 1 year, and 36 months for the other category. Got it. Thanks very much. So that's the EY take on maybe what could be a new model, which is simpler to deal with. Let's get the KPMG point of view as well. Mr. Maroo, you just heard Pranav's recipe or Pranav's model. Would you concur, or if you would like to sort of add or delete or tinker around, what would your model be? Capital gains.
More or less, I would sort of concur with maybe one tweak. Really, we need less complexity than more. So I would just keep it as 2 buckets: financial assets, risk-bearing assets, everything which is securities at 12 months, 10% rate, and every other asset at 20% with indexation benefit and 3 years. Most importantly, I would emphasize what Dinesh talked about. Stability is the key. In the search for simplicity, I would urge and request the government to not find a mid path and increase the rate, let's say from 10 to 15, right? Which it goes against the very grain of stability that we've been working. So simplicity is needed, but do it in a manner that doesn't upset the current system. So 10 going up, and there have been some murmurs about it. I would strongly hope that doesn't happen.
Yeah, so the 10% should not go. I think that's the biggest demand from the equity market. Every participant we speak with, first up on their budget wish list is do not change capital gains taxation, the rate or the period, at least from a listed equity point of view. Gentlemen, we need to take a very, very quick break. We have more to discuss beyond capital gains as well. Rima has a lot more questions, especially on personal income tax, coming back with just that.
Welcome back. This is the big budget discussion on the taxation front. And will the budget provide any tax relief for the common man? We've been in discussion with all our three experts. Mr. Kanabar, coming to you. The government has been trying to move away people to the new tax regime. They threw in a standard deduction of 50,000, but yet we haven't seen that shift away from the old regime to the new regime. Do you think in this budget this time we could see more by way of deductions or any sort of an exemptions for the new tax regime to make it more lucrative to enable that shift? And anything that, people who are on the old tax regime, should they be expecting anything?
So if you go back historically to the new tax regime for corporates, it took maybe about 3-4 years. But today, if I may dare say, almost 80-90% of the corporates are on the new tax regime, and rightly so. Because the last thing you want is to talk about deductions, exemptions, litigation surrounding those deductions and exemptions. The new tax regime for individuals has just been a year old, and it takes some time for any regime to settle down. And I would actually very much encourage that people need to move more and more towards the new tax regime. There is, of course, this whole fashionable ask that we need more exemptions and more deductions. I would rather have a far lower rate of tax than the government using tax to promote any of the policies that they need to do otherwise. So as we saw, for example, again, giving a corporate perspective, that instead of having tax deductions and exemptions, you had a PLI, which you put money in people's hand. Similarly, for individuals, we need to move towards a simple, rational regime. I mentioned earlier on, and I might like to sort of re-emphasize that there's need to reset the threshold limit every year. We have inflation. In fact, for capital gains tax, for example, we have cost of the acquisition index. Same thing, really, we need to ensure that we keep on moving the index of exemption up all the time. And I think the government would do very well to promote, do everything and more to promote the new tax regime and to increase the threshold limit. Remember that when the government increases the threshold limit, and I've done some working, shared it with CNBC, a 1 lakh rupee reduction in the threshold limit, or rather increase in the threshold limit, means that the government loses tax revenue by about 1,37,000 crores. We are looking at a point of time when the government's revenues are at a record, whether it is in terms of GST, whether it is in terms of direct tax. A 1,37,000 crore reduction in taxes actually does not mean that, because a lot of that money goes to people who are going to use it for consumption. And when they use it for consumption, you are giving a fillip to the FMCG sector, you are increasing your GST collection. So I would be very much in favor of government doing everything and more, A, to increase the threshold limit, and B, to make it more attractive for people to move to the new tax regime where we don't talk of deductions and exemptions.
Okay, got it. So increase the basic income tax exemption threshold. That could be perhaps one big sort of recipe on the personal income tax.
And move it all the way up also.
Sorry, Mr. Kanabar, if you could say that again.
And move it all the way up also, not just the basic threshold, but really take the limits up all the way up.
And this is for the new regime, the concessional regime.
That's right. That's right.
Okay, and therefore it will get people to finally migrate from the old to the new. Let's see if that comes through or not. Very quickly, gentlemen, we're down to the last 2 minutes on this conversation. Pranav, what else? I know that I think rationalization in the TDS structures has been a long-standing ask. There was earlier this issue of angel tax. Not sure if that has been fully addressed or not. I mean, what would be the other, let's say, 1 or 2 most important issues that you would want the finance minister to consider from a direct tax standpoint?
Right. So I would feel one is there are various anomalies under the 56 to 10 where shares are acquired by taxpayers and the price moves up between the date of acquisition, the date of the signing of the agreement and acquisition. That needs to be addressed, which is a gift tax provision which applies to acquisition of shares. And in many cases, we have seen that impact transactions and deals where acquisitions of shares are happening. I would feel the government needs to increase the limit for interest on housing loans, which has been at 2 lakhs. I think a minimum increase of from 2 lakhs to 3 lakh is something that might be called for. A good standard deduction increase is again something that has to be considered. Also, long-term capital gains are exempt currently up to 1 lakh. I think that limit also in line with inflation needs to be increased to probably 2 lakhs or so that we invite even more taxpayers into the financial investment space. So these are some of the things that, of course, boosting consumption as much as possible.
Take your point, but I'll tell you, with the current tax regime, you're getting 40,000 crores of retail inflows into the market on a month-on-month basis. So if you give more tax stops, then I don't know what's going to happen. The market's going to maybe explode. But anyway, we're not here to comment on that. Mr. Maroo, if you could sort of wrap this up, you have the last word. From a capital market perspective, no change, yes, that is the big demand. But anything else? Anything else which you would want to see?
So I would say from a general deal-making perspective, 2 asks. One that Pranav specifically talked about on the gift tax. It started as an anti-abuse provision. It has almost becoming like a gift of taxes given the way the section is worded. We need like very, very general safe harbor rules to prevent genuine transactions from coming under this net. That's one. The second thing I would say is on the new tech space, I think our IPO markets are booming thanks to a lot of retail participation, institutional investments. And in particular, our markets are outperforming NASDAQ and many of the other markets. And it's seen a wave of new tech IPOs sort of coming in. What I think would be good for the market is if the government came up with very, very broad-based exemptions, allowing companies that have overseas shareholding to migrate their shareholding into India in a tax-free manner. This is not a free lunch. All you're doing is exempting a reorg to bring these companies back to the public markets in India. You could, of course, tax them when the shareholders eventually exit in an IPO. So to my mind, this would be another large thing that you could consider from a capital markets point of view.
Okay, all right, gentlemen, thank you very much. I'm sure we'll have some more rounds of these conversations before we, actually get up to B day. But thanks for your perspective on capital gains and, of course, other important elements of direct taxation. Well, with that, Rima, I guess almost out of time on this conversation on taxes, of course, on the market.
And we're going to take your leave then. Thank you very much for watching the show.